Good day, fellow investors. I received a lot of comments from you. Thank you to analyze PayPal. And here we go. We'll discuss the stock price, the key business factors that I know about, make a stock valuation, and conclude with an investment thesis. If you like this stock analysis, please smash that like button to support the channel and consider subscribing if you haven't. So, just a quick stock overview. So PayPal was growing steadily over time, booming in the current e-commerce booming period, but since the peak 8 months ago, it has been really crashing, and it has crashed 60%. The current market capitalization is 146 billion and the price earnings ratio is 35. So we have seen many such tech companies crash, and we are now looking at PayPal, and let's immediately dig into the business. There are 426 million active accounts, so a big business, so a big share of the market, and a lot of people open an account because it's pretty easy and straightforward. However, they have been growing significantly over the last year, but now the guidance is for lower growth, and this lower growth is likely lower than the market expected, which is the reason why the stock got crushed, as things are returning to normal and active accounts have been growing just 13%. But let me show you here something that I think is the key when it comes to PayPal. If we look at revenue, 25.4 billion, and if we look at total payment volume, so 1.25 trillion, then the revenue share there is 2% of total payment volume. Now, I am using PayPal, and on Teachable, when I started my research platform 4 years ago, it was the only thing you could use to get payments. And then you get your payments in PayPal, and then if you need to do a conversion to another currency, PayPal simply kills you by taking so much money. So as a user of PayPal, I hate it, and I can't wait to use something else, because 2% of transaction volume is a lot, especially in the current world where we live in a fintech world where there are so many competitors trying to build services in the area. I am sure that something cheaper will come. And what I've been using recently is Wise. So you have much lower fees than PayPal. If you want to use this, if you want to check it, I'll put a link in the description below. So if you open an account, I at least get a fee. So I've been using, you get 9 bank accounts in different currencies, so you are not really losing money there. That is free, and the converting money is much cheaper, the sending is much cheaper than with PayPal. So I'm using this as an example of competition, and let me know in the comments if even you hate PayPal but have been forced to use it and are looking for someone to provide you a service to take away the PayPal and the extremely high fees that PayPal is charging. So my sentiment there is, okay, PayPal is a bad company. I can't wait to get rid of it as a customer, which is not the way to grow, and therefore for me it's too risky because of too much competition coming to get that cake. And of course, PayPal is the most accepted digital wallet, but so many competitors there that it will be very hard to grow for PayPal. Simply the ecosystems here are much stronger, easier to work with, and therefore also we analyzed Apple and the services there growing extremely fast, and Apple Pay is one of the services there. So given the investments, given the power there, I think Apple might do better, and also the other individual like Wise that I mentioned, etc. But let's go to valuation, let's see what to use. Okay, I'm not going to deep that much deeper, but non-GAAP EPS, similarly to free cash flow, 6 billion per share here, 4.7 let's take for our valuation. And then let's go to our table. You can download this in the link in the description below. So I've put in 4.7 here. I have to delete these present values because PayPal is not paying any dividends, so that has to be deleted here from the valuation. And now, what will be the growth rate for PayPal? They are forecasting 21 to 24% growth, but let's put a deceleration of growth, which is the killer of growth stocks. Let's put 10% and then 7% over the subsequent 5 to 10 years, a discount rate of 10%, and then a terminal multiple. Okay, let me put in a conservative estimation, let me put 20. My valuation for the stock then comes at 70, and this is if PayPal does well. So there is plenty of room for decline here, so 40% down. What is currently priced in the stocks? What is the best case scenario? So let's assume 12% growth, 12% growth, and the terminal multiple of 30 on the 2031 earnings here. So really a lot of stable, straightforward growth. And given the competition, I find it extremely difficult that PayPal will reach this. But this is what is priced in, and I'll later also show you what the market is pricing in. In a worst case scenario, let's say growth of just 4% and then even 2%, 10% terminal multiple for a declining business, and you have still 80-90% down for the stock. The sum is half the current price. The sum of my valuations is 40% down, so I would not invest in PayPal because I don't think the strength of the business is there to justify investing in that. Of course, going forward, it will be all about the growth, the key valuation factors there, the cash flows, and what the company will do. If they are slowing growth, will they do a crazy acquisition with the money, take on more debt or something like that? You never know, but that is the risk and reward of investing. Of course, if the management does well and keeps growing at 15-20%, then it will be okay. But that's the risk and reward in a highly competitive environment with much stronger players. For me, PayPal is simply too risky. They've been doing some buybacks, but nothing significant to mention here. And this is what I want to show you. What is the current valuation estimate? This is from Morningstar. So what are they seeing as a fair value to the stock price? So they are projecting 48 times the 2022 earnings. 48 times, or they are fair valuing something at 50 times earnings. And they say these are just some headwinds temporarily, that long term, over the next few years, they will return to growth. I don't know how in light of the competition, but they see it as a great long-term business, and that their business will grow 20% over the next 5 years and 17% over the next 10 years. That's really crazy exuberant growth, like that there is nobody else in the sector. And plus they expect margins improvement, so very rosy projections for the fair value estimate there. I don't buy these projections, extremely risky for me. I don't like the business, I don't like being a customer of the business, and when something like that happens, I think there are also many of you that don't like, they're looking for something better. Then people start slowly switching, the growth rate decelerates, at some point it becomes negative, like Facebook did recently. Again, Apple is the culprit, taking 10 billion away. But that's how this goes with these big businesses, and with the price earnings ratio of 40, 50 or 37, the risk is simply too high. This is my opinion, of course. Let me know in the comments what you think. Thanks for watching, consider subscribing if you haven't, and I'll see you in the next video.